Welcome to our channel. Today, we're diving deep into the golden rules of investing. Whether you're a seasoned investor or just starting out, these principles are essential for building a strong financial foundation. Let's get started with the top 4 rules of investing. Remember, this is not financial advice. Rule number 1: diversify your portfolio. Diversification is the cornerstone of a solid investment strategy. By spreading your investments across various asset classes, stocks, bonds, real estate, and more, you minimize risk. Let's break this down further. Risk reduction. When you invest in a single asset or sector, you're exposed to specific risks related to that investment. For instance, if you only invest in tech stocks, a downturn in the tech industry could severely impact your portfolio. By diversifying, you spread out your risk. If one investment underperforms, the positive performance of others can balance out the overall returns. Example: imagine you have a portfolio consisting of tech stocks, healthcare stocks, bonds, and real estate. If tech stocks decline due to a market correction, the other investments might still perform well, cushioning the overall impact on your portfolio. Exposure to growth opportunities. Different sectors and asset classes perform differently over time. Diversification ensures you're not missing out on growth opportunities. While one sector might be in decline, another could be experiencing rapid growth. Example: during the COVID-19 pandemic, tech stocks surged as people relied more on technology for remote work and communication. At the same time, certain other sectors like travel and leisure suffered. A diversified portfolio would have allowed you to benefit from the tech surge while mitigating losses in other areas. Stability. A diversified portfolio tends to be more stable and less volatile than investing in a single asset or sector. This stability is crucial for long-term growth and peace of mind. Example: consider the financial crisis of 2008. Investors with diversified portfolios that included bonds and other non-stock investments fared better than those who were heavily invested in the stock market alone. Actionable tip: consider a mix of domestic and international stocks, bonds, and alternative investments like real estate or commodities. Use index funds or ETFs for easy diversification. These funds automatically diversify your investment across a broad range of assets. Regularly review and rebalance your portfolio to maintain your desired level of diversification. This might involve selling some assets that have grown significantly and buying others that haven't performed as well to keep your portfolio balanced. Before we go to our second rule, remember to like the video and subscribe to the channel. Rule number 2: invest for the long term. Investing is a marathon, not a sprint. Here's why long-term investing is crucial. Compounding. The power of compounding means your earnings generate their own earnings over time, leading to exponential growth. The earlier you start investing, the more time your money has to grow. Example: suppose you invest $10,000 at an annual return of 7%. After 1 year, you earn $700, making your investment worth $10,700. The next year, you earn 7% on $10,700, not just your initial $10,000, resulting in higher returns year after year. Over 30 years, this compounding effect can turn $10,000 into over $76,000. Market fluctuations. Markets are volatile in the short term but tend to rise over the long term. Patience helps you ride out the lows and capitalize on the highs. Historical data shows that despite periodic downturns, markets generally trend upwards over time. Example: the S&P 500 has experienced numerous corrections and bear markets, but over the past century, it has delivered an average annual return of about 10%. Long-term investors who stayed the course through downturns have seen substantial gains. Reduced costs. Frequent trading incurs transaction costs and taxes. Holding investments long-term minimizes these expenses and maximizes returns. Capital gains taxes are also lower for investments held for more than a year. Example: if you buy and sell stocks frequently, you might pay significant amounts in brokerage fees and short-term capital gains taxes. In contrast, holding an investment for many years reduces these costs, allowing more of your money to stay invested and grow. Actionable tip: set long-term goals and stick to your investment plan. Avoid the temptation to react to short-term market movements. Consider strategies like dollar-cost averaging to invest consistently over time, regardless of market conditions. This involves investing a fixed amount of money at regular intervals, which can help mitigate the impact of market volatility. Regularly review your financial goals and adjust your investment strategy as needed, but avoid making drastic changes based on short-term market fluctuations. Remember, successful investing is about time in the market, not timing the market. Rule number 3, understand what you're investing in. Before investing in any asset, make sure you understand it thoroughly. This involves several key steps. Research. Learn about the company, industry, and overall market conditions. Understanding what you're investing in helps you make informed decisions and reduces the risk of falling for scams or hype. Example: if you're considering investing in a particular stock, research the company's financial health, its competitors, market trends, and future growth prospects. This might involve reading financial statements, news articles, and analysis reports. Risk assessment. Know the potential risks and rewards associated with the investment. Different assets come with different levels of risk, and it's important to assess whether the potential returns justify those risks. Example: stocks typically offer higher returns than bonds but come with higher volatility. Understanding the risk-reward trade-off helps you align your investments with your risk tolerance. Investment strategy. Align your investments with your financial goals and risk tolerance. A well-thought-out investment strategy considers your investment horizon, risk tolerance, and financial objectives. Example: if you're saving for retirement in 30 years, you might be more inclined to invest in growth-oriented assets like stocks. If you need the money in 5 years for a down payment on a house, safer investments like bonds or savings accounts might be more appropriate. Actionable tip. Read financial news, company reports, and analysis from reputable sources. Use tools like financial ratios, earnings reports, and industry analysis to gain a comprehensive understanding of potential investments. If you're unsure or lack the time to conduct thorough research, consider seeking advice from a certified financial advisor who can help you make informed decisions based on your financial goals and risk tolerance. Rule number 4, keep emotions in check. Investing can be emotional, but successful investors remain disciplined. Here's how to manage your emotions effectively. Avoid panic selling. Market downturns can be scary, but selling in a panic often leads to losses. Emotional decisions can undermine your long-term investment strategy. Example: during market corrections, it's common to see a significant drop in stock prices. Selling in a panic during these times can lock in losses, whereas staying invested allows you to benefit from eventual market recoveries. Stick to your plan. Have a clear investment strategy and stick to it, regardless of market conditions. Consistency is key to long-term success. Example: if your strategy involves regularly investing a fixed amount of money each month, continue doing so even during market downturns. This can help you buy more shares at lower prices and benefit from dollar-cost averaging. Mindset. Treat investing as a business decision, not a gamble. Approach your investments with a rational mindset and avoid making decisions based on fear or greed. Example: instead of trying to time the market or chase after hot stocks, focus on building a diversified portfolio aligned with your long-term goals. This disciplined approach can help you navigate market volatility with confidence. Actionable tip. Create a written investment plan outlining your goals, strategy, and rules for buying and selling. Review it regularly to stay focused and avoid making impulsive decisions based on short-term market movements. Practice mindfulness and stress management techniques to keep your emotions in check. Remember that market volatility is a normal part of investing, and maintaining a long-term perspective can help you stay calm during turbulent times. And there you have it, the top 4 golden rules of investing. Diversify your portfolio, invest for the long term, understand what you're investing in, and keep emotions in check. By following these principles, you can build a robust and resilient investment strategy that stands the test of time. Remember, successful investing requires a combination of knowledge, patience, and discipline. By adhering to these golden rules, you'll be well on your way to achieving your financial goals and securing a prosperous future. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more investing tips and financial advice. See you in the next video.